Hello, welcome friends. In this video, we are going to discuss about waterfall plugins. So, in last video, we have discussed about hurdle rate, soft hurdle rate, and how can they calculated that hurdle rates. And we are discussed in last video. Now we are going to discuss about waterfall provisions, and we have introduced the two concepts, that one American waterfall provision and European waterfall provisions also we have discussed in last video. If you want, see the last video. Now come to the point. In American waterfall video, what we have discussed, it will be taken incentive fee based on deal by deal profits, and whereas European waterfall, it will be based on fund level. It means it will be all of fund they will take. So welcome to fund accounting classes. Now we are discussing water provision. What is meant by waterfall provision? Waterfall provision means this is a provision or term that will be there in our LPA agreement, which will define cash flow distribution hierarchy. So how we can distribute our cash in a PE fund, that is a private equity fund. So we go for the organization or business, there will be a hierarchy will be existing every business. How the hierarchy will be existed: CEO, CFO, and after that members will be after that business level managers will be there, and vice president will be there, and after that workers will be there, staff unions and peons. This type of hierarchy will be there for any organization. Same like as in PE fund, if they have any cash, how can they distribute their cash in a hierarchy way? This will be discussed in this provision, waterfall provision. So waterfall provision means that will keep coming from up to down. That's the way we will distribute the cash in a sequence. This fund distribute money to investors at a different point of time, like first to fifth year, first to second year, first to sixth year, first to fourth year. This different point of time they will pay. They will pay for, like if you have income amount like dividend, interest, or etc. They will pay first in first 3 years, and after that they will distribute their capital distributions like any amount, sale of investment, etc. While distributing this money, if that a general partner is eligible, the fund should distribute some position to general fund and fund house also. So that eligibility is decided based on this term in LPA agreement. Generally, the preference is given to investors. So once their principal and minimum return is distributed to them, then GP will share in the remaining cash in the funds. So normally, how will they go? First, they will pay the amount to investors, whatever the amount will be there on the basis of their principal. After that, what are the return they are assured minimum returns, they will pay na that minimum amount they will pay. After that, if they have any money, they will take the share of general partner, and there may be some preferred return. This amount was calculated based on hurdle rate. Here, preferred return means that principal outstanding, whatever the principal outstanding is there, principal outstanding into hurdle rate will be taken. And if the investor paid any amount to a fund, his preferred ration is payable. So they will see that in a based on hurdle rate. So if preferred return payable will keep increase if investor principal is outstanding more paid, since in a cumulative return, if the general partner can return the money in a quick time or collect the money from investors as last as possible, so preferred return will be less. So it will be preferred return will be based on investors principal outstanding. If the principal outstanding is more, and they will increase the preferred return. If the prefer this money collecting money is late as possible, quick time, then preferred return will be yes. There may be a direct relationship to that preferred return and outstanding principal, how they are correcting. And so whatever If want to calculate a preferred return and carried interest based on some followings maybe follow. So that will be what is the fund size we require, what the investors, what are their investment, what is the hurdle rate is there. Hurdle rate is required because preferred return, how we calculated outstanding principal into hurdle rate. First we will take for preferred return. What is the vintage year? Vintage year means the fund which he started in the year is known as the vintage year. We will take in, and whatever the amount paid, that management fee or any other fees paid, they will see that amounts paid. So whatever the management fee that companies what paid, that will be seen, and whatever the contribution is there, whatever the distribution is happened, and based on that we will reach out the principal outstanding. On that principal outstanding we will calculate the preferred return. Preferred return may be on basis of hurdle rate, whatever the rate was provided. Based on that hurdle rate we will calculate the preferred return. Whatever the opening balance is there, whatever the capital contribution is there, and it will be added, and on that amount hurdle rate will be calculated. If any distribution is happen, we will be deducted from the opening balance. So we will take the capital, and capital any addition is there happen in for capital, we will add, total capital will be coming, that is outstanding amount, and out that outstanding we will take the hurdle rate, that will become the preferred return, and after that it will become the total amount, and whereas preferred return will be required to calculate. And if there is cash availability, what is the amount is there, we will see the cap principal. If any amount is paid, after that principal pay amount we will calculate the preferred return. On that preferred return, after the preferred return is, we will calculate that general partner share and that limited partners shares may be in ratio, whatever the agreement is there. If the fund has any NAV, that total amount is there, and there may be any possibility that the general partner can get any amount, then it must post the amount. Entry will be carried interest expenses accounted to carried interest payable. First we need to we need to post the entry related to interest expenses, carried interest expenses. Firstly we need to create a liability, outstanding liability, so that we need to post the entry carried interest expenses account debit to carried interest payable amount. This is related to GP share. What is the possibility to pay to GP share? That GP share will be passed the entry carried interest expenses account debit to carried interest payable entry. And if the fund he is able to sell, it is all investments, whatever the amount he is there, if they sell that amount, then also we need to calculate only for that general partner, and we need to put the entry same carried interest expense account debit to carried interest payable entry we need to post. If there is any catch up is there, then we will see that carried interest is equal to catch up plus profit share we will take. For the carried interest means catch up plus profit share will be calculated. And in case of waterfall or cash flow distribution, will stop at catch up stage. So these are payable if there is sufficient cash. So after the catch up we should not get the general partner share or limited partner share. If there is no cash or any insufficient cash, there is no obligation to pay all eligible amounts for preferred return or principal or catch up, etc. Whatever we need to pay, it not required to pay to that person if there is no cash or if there is insufficient cash. If this fund has a remaining cash after the preferred return, then fund house or general partner will get the all catch up amount and the balance cash is shared between the general partner and limited partner in the ratio of 20 is to 80 ratio they will calculate it. So we need to see the catch up point here. So here what is meant by catch up? Catch up means this is provision in waterfall method or provisions allow the general partner to take an exclusive portion of amount from the remaining cash before the profits or cash can be distributed between the general partner and limited partner. Means what is this catch up? Catch up means in waterfall method. Waterfall method means it is a cash flow hierarchy. In that cash flow hierarchy, once the hierarchy is completed, whatever the cash is there on that cash exclusive portion of amount from the remaining cash before before saying distributing that profits to general partner or LP, it is catch up pointer. And here general partner is negotiated some priority in the remaining cash after the investor related payment was paid. Whatever the amount is payable to investors will be, it will be whatever the cash is available. We need to pay first principal amount, after that preferred return. After the preferred return, if they hit their cash, general partner will negotiate with them and he will ask for some amount. If the fund distributed any principal amount and any preferred return, investor will be happy. And if the remaining cash, the general partner will not happy to share that small amount since he is forced to get some return. He there for that is efforts he need to make that amount in his hand only. So if they have any high like plans the exist time for investment or plans for IPO strategies, sell investments at good value, etc. are done by him. So investor got that much return, so he can negotiate to have a catch up class in the waterfall provision. So at the time of entering waterfall provision, they will this general partner will clearly tell that we need a catch up clause in the LPA agreement at the beginning of the fund, so he can have a he can take position of remaining cash first and they shared balance is shared to in 20 to or 80. Normally, after the sharing to investors, whatever the cash will be there, on that cash he will take the cash up, and after that he want to share the partner, general partner and limited partners. Generally, this cash up amount is agreed at 20 or 25% of preferred return, since the profit share ratio is also agreed at 20%. So generally it will be 20%, and the remaining 80% that the limited partner, all limited partners will need to take on that amount. For example, if you sold any amount, if you have invested some amount, if you have invested 1 lakh rupee and if you have sold for 2 lakh rupees, then profit will be 1 lakh rupee. The general partner share whatever the amount on that will be 10%. 2 lakhs into 10% will become I think 20,000. And if he need to pay firstly the persons who has invested the principal amount, so on that principal amount first principal return will be calculated. After that preferred return will be calculated. Preferred return means whatever the rate common return payable to investors. After that preferred return he will calculate the catch up return, and after the catch up return they will share the ratio in the 20 is to 30 20 is to 80 ratio, and preferred return catch up will be calculated. And where has a if catch up means what we have told in the waterfall provision, there may be exclusive provision for remaining cash before remaining profits or cash can be distributed between LP and GP. So before paying to LP, he will raise his own points. Whatever he have, he needs to negotiate on the same priority. And there is the catch up amount is agreed, maybe 20% or 20% of based on preference return, whatever the risk is there, based on that they will agreed the ratio in 20 or 25 issue. Next one. Here, clawback. Clawback means this is the provision gives a right to limited partners to pull back or excess carried interest already paid to general partner in a fund. So, what we have discussed in last one in catch up, general partner will get the share before paying to general partner and limited partners. Whereas in clawback it will tell that the limited partner to bull back any excess carried interest already paid to general partner in a fund. For example, if a fund is arranging in USA, if you go for the American waterfall method, if you go for American waterfall method, which means the general partner can take carried interest if the profits are made one investment also when it is sold. Fund has if you have three investment, four investment, whatever the investment he sell, on that investment amount he will give the profit. If you are in not in a that market and you need to go and for a European waterfall method. European waterfall method means where we need to calculate on whole on fund basis. So total profit in the fund is zero, and in this case may be carried interest carried already paid in general partner can be pulled back or called back. So here we should know the 2 points. One is catch up, one is clawback. Catch up means if the person not have any intention to get money kingdom, he will come and he will fight for other person. Whereas in other cases it may be they will want to fight. They need to fight only. And once rate up to 20% or 25%, what is the better and how it is negotiated to 25% if general partner wants. So whatever the amount is there, we will calculate clawback period. If any amount is available and principal, first whatever the amount is there, first we need to pay the principal amount, and after that we need to pay the preferred return. Whatever the remaining cash exists, then we will go for match up, and after that we will go for this cash will be distributed after catch up. This P and one market is there, that market name is not remembering, and carried interest. And here general partner share as carry is share has carry this catch up to is 25% or 20%. Even take the risk. If there is any risk, they told that they will take care of anything. Now if the markup, if the catch up is some percentage he is given, 20% he is given, then general partner will get the general partner will get over water point, and if they catch up he some percentage, the share of general partner is overall commitment in 1867 only. And